Good afternoon. Welcome to today's Wednesday market review. My name is Stock Darts, and we're going to do what we always do on Wednesdays. We're going to go ahead and take a look at the four major market indices. We're going to look at the S&P 500, the Nasdaq Composite, the Dow Jones, and the Russell 2000. Once we finish analyzing the markets, we'll also take a look at the U.S. dollar. We'll see how it's behaving. We'll see how it's affecting gold and silver. We'll also see how oil's behaving, and then we'll move on to chart requests. If anyone in here has a chart request, or if you are watching this as a recording and you have a chart request, you can always find me on Twitter at StockDarts, or you can find these videos at YouTube StockDarts, and I'm more than happy to give any take on a chart that you have. So if you're in here today, you could just type it into the chat tab, and I'll go ahead and take a look at it. If you're watching this as a recording, you could always ask me on Twitter, and I'll be more than happy to help you out. If you like the content you see here, of course, you can follow me on Twitter. You can also find me at patreon.com/StockDarts, where I post weekly blog content, including trade ideas, watch list ideas, the reposts of these Wednesday market reviews, and anything else I might find or think about during the middle of the week. That's typically the best place to go if you're looking to try to get an idea of what kinds of trades I'm taking or what kinds of trades I'm recommending to my Patreon subscribers. There is some subscription services there, but most of the stuff goes free after a few days or after a week. Once it's really no longer relevant as far as entries, but it's still very relevant as far as education is concerned, or getting a better idea or gauge as to how I trade and what kinds of stocks we look for as far as my trading style. Typically what we like to do is analyze the kind of market environment we're in during these Wednesday market reviews, and then I try to tailor my trading to match that. That way I'm not trying to short during a strong bull market. Same thing, I'm not trying to go long during a choppy market or a bear market. And just try to manage your trading style to go ahead and accommodate what the market is giving you, rather than trying to shoehorn the wrong style of trading into the wrong type of market environment. So with that out of the way, let's go ahead and take a look at the S&P 500 through the ETF SPY. As you can see, we are basically at all-time highs. The market has done a really good job of rallying over the last week and a half, particularly on the S&P 500 and the Nasdaq Composite. We're seeing sector rotation once again take place, and going back into a lot of the names that did well last year. And this was one of the big keys to the beginning of this year, in the middle, especially as we headed into spring, was a market that was rotating out of tech and out of a lot of the safer names that did well in 2020, and into some of the recovery names and some of the names that really got hit hard last year. And what we've seen now is kind of a shift right back and back into those names, and kind of away from a lot of energy names or a lot of industrial names. And that's the kind of back and forth that typically happens. You're not going to have one sector of the market that always goes up. A lot of times it goes back and forth, and when you have a market like the one we have now, where we are, for the most part, steadily climbing, and when we correct through time, as you can see pretty clearly on this chart. The two times that the market really consolidated, it did so in a sideways manner. Over here from April to about the beginning of July, and then previous to that in February and March, where even though the market in the bigger scheme of things was climbing steadily upwards, it spent a good portion of time trading sideways. And what happens when you have a market that consolidates sideways like that is you have money that rotates out of one area and into another, and that way the overall market still does fine, but you have individual pockets that do poorly or better than the overall markets as the money rotates back and forth. And that's a normal function of how trading works and how investing works. If someone gets in at a good value point on, say, a tech stock like Amazon, and it climbs up to a certain point where they don't consider it a value anymore, they're going to go ahead and take profits there, and then they're going to go ahead and reinvest that somewhere else, into another area that they consider to have value. And if the market is healthy enough, that can all be done within the context of a market that stays strong without having to need a broader market correction. And it isn't until you have strong, broad market corrections where everything rotates out at the same time, because at that point there's nothing that's really at value. But that hasn't been the case over the last year. We've had pretty nice pockets of rotation back and forth, and that has allowed the market to sustain its upwards trajectory a little bit longer than maybe some are expecting. And until we see something change, that's kind of the behavior we should expect. I think it's a positive right now that the Nasdaq and the S&P 500 have broken out. I think that bodes well for the health of the markets as we head into the summer months. There was a pretty good chance that we were going to trade sideways and possibly even correct further down, and it looks like for now we've kind of staved that off. Now there's still a possibility that happens, but the further and further we get away from the level of resistance that we've just broken through, the more likely that the market stays in a pretty healthy state, even once it does start to consolidate more sideways. So now that we've got the summary out of the way, let's really dive into the S&P 500. Let's look at the key levels and see what we can gauge out of just this in a vacuum, right? So as you can see, the last time we had a nice consolidation range, like I said, is this rectangle here, which took place basically around April to the end of June, very, very beginning of July. And we broke out and have kind of steadily run up over the last week and a half, well, basically in July. And at this point, that level that was a strong resistance, 422, that should now be our support floor. And as this was an area that was really important, this was an inflection point that we discussed for a few weeks in a row as we kind of dealt with it. There was a good chance that if we failed here, we were going to go ahead and break down, head back and head to some lower levels. And as you can see, we had a poor reaction to an FOMC statement on a Wednesday. We had a quick gap down the following day, and then we rallied strongly. And I think that was a good sign that there were still a lot of buyers in support of this. And that little shakeout was just what we needed to finally break out of that range. And we were able to break right through that key inflection point around 422. And start to rally upwards. And as you can see, we're reaching a point now where we might need to correct. You see these two little hammers. We're going to go ahead and zoom in a little bit. That we formed yesterday, and now we are trying to form today. Those are positive candles or constructive candles when they're at the bottom, when they're at support levels. But when you're printing hammer candles at resistance levels or at highs, that's usually a signal that there's more selling pressure coming in, and it's affecting the price action, even if only temporarily. And while we're able to kind of erase it by the end of the day and close near the highs, the fact that there are sellers that are starting to show up is usually a sign that there's a further correction coming. Now, again, as we move forward and we take a look at all four of the indices, we'll see that there's something else going on here, and that rotation has already taken place, and there are other indices that are down. You can see IWM is down 0.3%, while these others are up kind of 0.2, 0.3. But as far as looking at the S&P 500 in a vacuum, and not really looking at it as far as the overall market, you can see that we have sellers that have come in the last 2 days, and even really the last 3 days, because there was still a little wick here at the bottom last Friday as well. And so we have sellers that are starting to come in and impact the price action, but it's not enough to move the needle too far yet. However, when you start to see that, that's your first signal that there's a possibility that we might need to correct a little bit. Now, it could be that this correction takes place sideways. I don't think that those wicks are enough for traders to get nervous about the price action. And again, when I'm talking about getting nervous about the price action and expecting a correction, I mean it in the shortest of possible time frames. I think if you look at what we're seeing here in the intermediate to long-term time frame, the market is in a very healthy state, and there's no threat whatsoever right now of a stronger correction unless some news really comes out of left field. As long as that doesn't happen and we're just trading off technicals, there's a lot of support underneath that's going to kind of keep the price action from really dropping below key levels. So when I'm talking about the fact that I'm starting to see sellers show up, I mean it more within the context of maybe we need to take a trip back to the 20-day moving average, or maybe we need to come down and test the 422 area. But as far as a market top or market correction of any kind of real significance, that's not really in the cards yet, and certainly not from here till next Wednesday, which is when we'll meet again. So keep that in mind. At this point, the market is in a very nice state, and it's very strong. And until we see a change in character in that, we have to assume that we are going to start trading more aggressively to the long side and start trading more momentum strategies as we finally broke out of this really choppy zone. And so if we get a nice dip back to the 20-day moving average, then that's going to be a really good buying opportunity. If we see stocks that are not extended like this, right? So if you're trading the S&P 500 right here, this is not a good trade to go long, right? Because we've got If you come all the way down to this 415 level, we've got 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12 candles. Only 2 are red. And even the red candles still kind of finished above the previous day or pretty close to that. So you've got 12 days of pretty much unmitigated rallying. And that's going to make it difficult for a trader to try to go long here and get good risk reward, at least as far as this chart is concerned. However, because of the patterns we're seeing as far as rotation is concerned, there are stocks that are still providing good risk reward. They're getting a little bit harder to find because, again, the longer the market kind of persists in this upward trajectory, the less charts that give you good risk reward, because most of them have followed the market upwards. And the ones that haven't followed the market upwards are, of course, the ones that are showing or exhibiting a lot of signs of relative weakness and are typically the ones you want to avoid. So, the longer this goes, the harder it is to find trades. But I think as far as this week is concerned, there were still a couple of trading opportunities that arose, and there's still some charts that are giving good risk reward. And as long as we find those charts, we can kind of trust that this market is still in a healthy state. And even if the S&P 500 starts to drift sideways, if we see the Dow Jones or IWM pick up a little bit of relative strength, we can maybe play that rotation game back again as the little seesaw goes back and forth between money coming in and out of different pockets of the market. So I think overall, as far as our trading strategies are concerned, we are definitely in a little bit more of a safer place to trade than we were maybe back in May and June, where the market, again, was not in a negative state, but was definitely in a much more erratic or choppy price action that made it more difficult for sustained moves. We're definitely in a market that's going to give us a little bit better sustained price action. And now it's just a matter of making sure that we're finding the good risk-reward opportunities, and we're not succumbing to our emotions and trying to chase stocks that have already moved without us. There's always going to be more stocks. If you miss moves like this, which happens quite a bit for all traders, you just have to be patient and wait for the next pullback or wait for the next consolidation range, and then go ahead and enter your trades in that manner. And that's always the best thing, is to just be patient and wait, because the market will always give you another opportunity. But what you don't want to do is let the market kind of fool you by trying to get you to chase price action or break your rules. All right, if we take a look at the NASDAQ, we'll see again. In this case, this rally has sustained itself for a little bit longer, right? And if you take a look at it, we had a little bit of a sideways move here as we were trying to go through this inflection point at 342. But we started rallying all the way back in the 330 level. And actually, you can see we started rallying all the way back here where we kind of double bottomed. But you can see a very clear string of nice green candles with only a few red ones kind of spaced out in there. And this was the big rotation that I was talking about earlier. Tech was trading sideways. You can see, we zoom back a little bit, the tech sector had a nice rally to close out last year, but as we started this year, money rotated out of technology, and you can see it pretty clearly here as this channel broke. We had this volatile sideways consolidation, and so we shifted to a sideways price action or sideways environment on the NASDAQ, even as the S&P 500 and the Dow Jones continue to kind of climb upwards. And again, this was a very clear signal that money was starting to lose a little bit of confidence in the levels that a lot of tech stocks were at. Like I said, typically smart money, especially investment or institutional money, will get in at the bottom or get in at really good value areas. And as that equity starts to not become a good value, they start to scale out and try to redeploy that capital somewhere else. And that's what happened here. And eventually, we had enough of a pullback in enough equities where a lot of those tech names became good value again, which kind of happened right around here, around the 320, 315 area. And that's where they started to redeploy. And as you can see, eventually the effects are felt across the board, and that's when the NASDAQ started to rally again. Now, we're getting a little bit extended. Just like the S&P 500, we've got a couple of hammers in the last 2 days, which is showing that sellers are starting to kind of impact the price action, at least in the early parts of the day, even if they can't finish it off. So there's a good chance that this skinny little channel we're in will eventually break. right, so let's zoom out a little bit, and we can see it a little bit more clearly, right? So these kinds of patterns are typically not very sustainable, right? You don't normally climb up high and tight like this for too long. You can see the last time we had a move like that happened here in April. We had a little bit of a rising wedge, and it eventually resolved into a sideways price action with a little bit more volatility, and then rolled over, and that's when we had the last real threat of a breakdown on the NASDAQ. And so we're starting to get that price action again, and you can see that actually could be extended even further back. You can see that we've already been kind of climbing steadily upwards, and so sooner or later that's going to break. And the key is, when that breaks, what happens on the break, right? Because breaking this channel and breaking sideways is not necessarily a negative indictment on the price action of the NASDAQ, because let's face it, this is not really sustainable for any kind of longer term time frame. And the key is, when you do lose that, do you just come down and test the moving average and then just start climbing upwards again? Or do you start to threaten a price action rollover, and you start to kind of break through key levels? I think at this point, the more likely scenario will be that we just come and test the 20-day moving average and then move on. For those that are regulars, we'll often look at the moving averages as a good gauge for how sentiment is behaving. And we are starting to get the moving averages align themselves once again in what I would consider a rally mode. You got the 20 crossing over the 50. You've got the 50 curling underneath and climbing. You've got the 200 climbing. And when you start to see that spread between the 20 and the 50 increase as they spread out, that is usually the sign of an accelerating trend, because obviously it's pulling the 20-day moving average up with it, and then the 50's coming up and following a little bit more slowly. But when you see that spread, that's because, of course, price action is really starting to climb. And so even though moving averages are kind of a lagging indicator, and they're only curling up because price action has already moved up, when you see them on this alignment, that is usually a good indication that sentiment has shifted enough where there will likely be follow-through. And I think that's one of the keys with these moving averages is they help you visualize the momentum of traders' thoughts. Remember, when you're looking at this chart, you're not just looking at price action, you're looking at what traders consider to be the price of the NASDAQ and what their sentiment is. And so when you look at these trend lines, that is a picture of what traders think, and they're positive right now. Same thing with the moving averages. And so when you start to see them align like this, you can see the last time we had that kind of alignment was back here as we started to break out in November and December of last year. And as you can see, once the moving averages started to spread out, that was really the beginning of a strong rally upwards. And so we are on the cusp of what could be another good rally. And if that's going to be the case, if we break this channel and come back and test the moving averages, it should be met with strong buying demand, and it should be met with a quick surge back to whatever the highs were that were formed, and then maybe a bull flag, and then you try to move onward. Now, if we break the 20, come back and test the 50 quickly, then that's probably telling us that we're not ready to really rally, to experience a multi-month rally, and we'll probably have to come back and retest this green line at the 342 area and really establish that as good support. And if that's the case, that's still not negative. It just means that we should expect a little bit of slower price action as far as our rally mode is concerned. And I think that might be the case if we continue to see the Dow Jones and IWM behave more weakly than what we're seeing out of the NASDAQ and the S&P 500. Again, right now we're seeing a market that's a little bit divided, where we are seeing pockets of strength. And again, if you're looking at the NASDAQ in a vacuum, this looks like an equity that's ready to really start running up, and probably has a good couple months to rally. However, that's not going to be the case when we look at the Dow and IWM. And until we see that change, it could be that we're going to see a little bit of choppiness coming back and forth between these as they try to vie for the leadership position as far as the four major market equities are concerned. So, real quick, the key levels here. Obviously, to the upside, there is no key level. We are literally at all-time highs as we speak. This channel is not going to be significant as far as support is concerned, but it will be something to watch in the very short term. More important will be the 20-day moving average, and then this 342 level. And we should not breach that from here to next Wednesday. There's almost There's almost no scenario right now where we lose that from here to next Wednesday, unless news really, some news event comes out that we just are not anticipating whatsoever. And if not, if we're just trading off of regular price action, there's very, very little chance that we head down and test this by next Wednesday. Probably not even this month, but there's still a few weeks to go, so who knows? But right now, the key area is what we do at this channel and what we do at the 20-day moving average. All right. Actually, let's just do this. The Dow Jones. All right. So, very different picture as we look at the Dow. Right? Pretty clear. We're still in a sideways price action here, or environment. We came up, tried to test new highs, not even all-time highs, and we've pulled back the last couple of days. So the selling pressure that we're seeing on the S&P and the Nasdaq, it's only manifesting as lower wicks. It's actually a red candle in the Dow Jones, and even though today's candle is green, it is lower than yesterday's price action for the most part, and lower than Friday's price action. You can see the moving averages are trading basically flat and rolling down rather than up. And so the Dow Jones looks like maybe it's ready to navigate towards a sideways price action and follow what the Nasdaq has already done for 2 months. And that could be the case. If that is the case, then I don't expect the S&P 500 and the Nasdaq to really rally with any more strength than what we're seeing now. I think that they'll probably slow down and kind of patiently wait for the Dow Jones to catch up. If the Dow Jones can get back to new highs, then that probably will lead to strong moves on the Nasdaq and the S&P 500 and an extension of their current rallies. The key here is for the Dow Jones not to break down, right? Clearly money's rotating away from them at the moment, but it's not rotating outside enough to really affect the overall markets. And I think that's kind of the key. This is another trend that was reaching a level that is pretty hard to sustain. You've got a channel that has kind of stayed intact for a long time, and we're starting to finally see potential, signals of it breaking down. We had a couple that were false breakdowns, and even last time was already considered a false breakdown. And the more often that this trend line gets challenged, the more often the moving averages get challenged, the more likely they eventually really break. And so if we come back and test it again, you can see it's going to happen pretty soon. And again, this channel, I don't think is as significant as the moving averages, but they're all going to coincide in the same place anyway. If the Dow Jones breaks all of those, I think that's going to be a significant break, and it's going to lead to a move right back down to 336, and it's going to probably lead to an extension of this rectangle where we kind of trade like this for a little bit longer. And if that's the case, more likely than not, the S&P 500 and the Nasdaq are going to come back and retest their breakouts, right? I don't think it's going to be negative, but they may need to come back and test their moving averages and retest the top of their previous range, or at least the 20-day. So at this point, the Dow Jones becomes something we do want to watch, just to make sure that the weakness that is coming into it doesn't bleed into the overall markets. And in order for that to be the case, we want it to stay above this trend line and stay above its moving averages and wedge itself up between all-time highs around 350 and this channel that keeps kind of climbing up, and the moving averages that keep climbing up with it. All right, so everything I mentioned for the S&P 500 and the Nasdaq, I think kind of applies here, just on a weaker point of reference. We're still in a pretty good market environment, and it's really a matter of whether we are able to sustain this to the upside. The key levels we kind of just went over, which again to the upside is 350. To the downside, we've got a very key, significant breakdown spot here, right at 342, 343. If we lose that, then we probably head all the way down and test the 336, 335 area. If we can bounce here, then we're going to come up and retest 349 and then 350, 351 in short order. And so as long as we stay priced or wedged in between that, I think it's indicative of a healthy market. If we break below it, it's still a healthy market, but it's a market that probably needs more time to kind of correct a little bit. And that might be the case now that we've seen the Nasdaq and the S&P 500 rally. If they take a breather, then we might see the Dow Jones kind of pull back and really come back and test support. This is going to be a factor also for those that are looking for sector rotation. If you are looking for money to rotate back into recovery stocks, then watch what the Dow Jones does. If it starts to break out towards highs, as the S&P 500 and the Nasdaq pull back, then that's your signal to get into some of the recovery names. If the Dow starts to pull back further, then wait for it to set up and wait for it to really find support at the 330s. And I think at that point, then the rotation back into that becomes a little bit easier to trade because it'll be at a much clearer value spot. And then finally, the last one we have is IWM in the small caps. And as you can see, in this case, we don't even have green candles. We just have a straight string of red candles. We have volatility increasing. And so IWM has failed to rally along with the S&P 500 and the NASDAQ. This, again, is indicative of where money is rotating. I think in this case, it's also an indicator that maybe, maybe we're still a little bit more fearful than we maybe are admitting. Because traders are sticking away from more volatile assets or risky assets. So they're going back to tech and the S&P 500. The safer Dow Jones stocks, while they are struggling, are still holding up okay. And the one area that really we're starting to see traders kind of leave a little bit is the small caps. Now again, it's not the end of the world. The small caps have done a really good job of catching up and participating. They've also done a really good job of consolidating for a while now. We also had a potential head and shoulders pattern that didn't really materialize. And so it's not a negative chart. However, it's not necessarily a chart that's ready to rally. I think it's pretty clear here that it's kind of stuck in a very, very broad sideways range. If we use our rectangle tool here, you can see that IWM is mired in a broad consolidation range, and it failed at the highs yet again. And whether it comes back and tests the bottom now is kind of the critical spot, right? I mentioned last week, when you see these broad range consolidations, and we'll go to the NASDAQ for it at first. What often happens is you trade sideways, and as this range starts to mature, you start to pull back higher and higher, right? You don't come all the way back to the lows. And eventually you get to a spot where you just consolidate right at the highs and then you break out. So one of the things we want to watch with the small caps is what happens here. Do we stay here around the moving averages and then bounce right back and start testing highs again? Or do we come back and test the bottom of the range? And so I think this is one of the charts that's kind of important to watch as far as gauging whether the market is really going to enter a full-fledged rally mode where trading becomes super easy, or if we're going to stay in the environment we're in now, which is not as difficult as what we had the last couple of months, but not necessarily easy because there's still going to be pockets of strength and pockets of weakness, right? If we can get all the markets together to rally, then that's going to be much easier because pretty much any stock you buy is likely going to be in a part of the market that's rallying, right? Because everything's rallying. Right now, it could be that you look at a stock in a certain area and it could be pulling back because rotation is kind of occurring at that point. And I know it seems like I've said rotation a million times today, but that seems to be the theme of the market environment we're in right now. And so what we want to see here is we want to see IWM bounce off of these moving averages and come back and test the 233 area, build up momentum, and then break out. If it heads back down and starts testing 211 or 208, I still consider that to be a good floor, and I'd expect that to be a good buying opportunity as far as buying the dip. But it likely will mean that we're still in a market that's pretty mixed and still subject to pockets of strength and weakness that keep bouncing back and forth. I think that kind of covers it for the markets. Like I said, we're in a mixed state. Things looked really good. When we're just looking at the S&P 500 and the NASDAQ, it looks like a market that is ready to run and really ramp up and run higher throughout the summer. But then when you look at the Dow Jones and IWM, we instead have a picture of a market that's actually getting tired. and maybe even starting to shift towards more neutral or negative price action. And so when you have those cross currents where you have two parts of the market that are trying to run up, you have two parts that are trying to correct, that typically leads to more difficult to diagnose price action. And if that's the case, it might be that we need to continue to really monitor to see where money is rotating, to see where strength is coming in and out, and not try to get fully aggressive like maybe what we saw at the end of last year, where basically everything ran up together. And if that's the case, then whatever. We just have to dig through our watch list and find which stocks look good and which stocks don't look good. But overall, like I said, I think the markets are still pretty healthy. I think in the bigger scheme of things, even if IWM and the Dow Jones correct further, we're still a market that's near all-time highs and has run up for more than a decade now. And until we see a real change in that, we just need to keep buying the dip, and we just need to be patient and wait for the right opportunities and keep taking advantage of this until something changes more drastically. Let's take a quick look at the US dollar. As you can see, the dollar is starting to rally. This could eventually impact the markets. For the moment, it's not. But keep in mind, anything that's priced in U.S. dollars has the potential to go down whenever the U.S. dollar goes up. It doesn't always happen because sometimes the strength of the dollar is more important than the actual price. And so if the dollar, signs of dollar strength could sometimes affect certain areas of the market. But typically, if you have something priced in dollars, as the dollar goes up in value, then that commodity has to go down. That hasn't been the case yet, but if the dollar continues to rally, it could put pressure across the board, and that's something that we might see on gold and silver, but we obviously haven't seen it in the stock market just yet. But what we're seeing today is a dollar that is starting to break out past the key range here. This is 24.85 on the UUP index. We'll look at individual currency crosses in a second, and we'll see how that's reflecting across the board. But it looks like the dollar wants to rally. It had a really good bottoming spot here. A lot of strength came in off of that FOMC statement I alluded to a little bit earlier, where they started talking about raising rates. And since then, I think that there's been a change in character where it definitely has reflected a little bit more strength. If we look at the euro US dollar, you can see, and again, this chart is going to be inverse to the last one, right? Because this is going to be a chart of the euro. So down is actually good for the US dollar here, right? Because the euro is dropping versus it. And you can see the euro has really struggled and has really started to break down as the US dollar has gained some strength. It is trying to hold on to dear life here. We take it back, and we have to go back pretty far to see exactly where the next level of support is on the euro. It's going to be right around 117. It's kind of at the bottom of that 117.9 right now, but it needs to go down all the way to 117 flat before it hits real support. So there is a little bit more downside in the euro, which again means more upside for the US dollar. If we look at the US dollar versus the Japanese yen, we're going to see again a commodity that is rising steadily. Now it has pulled back over the last 4 days, which is interesting considering that as an aggregate it's gone up. But again, I think that was partly due to euro weakness. But the US dollar is right back at its 20-day moving average, and it is in a pretty clear channel here. And I think at this point, for you Forex traders, this is probably not a bad spot to start looking for an entry signal. I don't think we have one yet, but we could get one in the next couple of days. And if this channel continues to persist, then we should get a bounce and a move back to the 111 area. And then finally, we have the US Canadian, which, as I mentioned last week and the week prior to that, was probably ready for a good bounce. We are seeing some nice volatility come in. We are starting to see some bouncing. And I think that there's a pretty good chance that this is going to run up probably all the way up to its 200-day moving average, because we're starting to see weakness come in oil. And that's the major commodity, obviously, that gets traded between the U.S. and Canada. And as you can see, oil looks like it topped out here at the $75 price range, 76. Now, this is still a positive chart. And what I mean by topped out, not necessarily that it's going to break down, but that it has found a short-term ceiling. It needs to come back and retest not only its 20-day moving average, which is starting to break today, but probably come down and test the 50-day, and maybe even come down and test the 67 range. So I think that there's further room for downside on oil. You can see volatility increasing as it starts to really hit the top of its recent ceiling. And if this continues to drop down, that should put more positive momentum into the U.S. Canadian cross. So again, if you're a forex trader, you like to trade currency crosses, I think the U.S. Canadian is in a decent spot here. Although risk reward is a little bit worse now than it was maybe a week ago or even a day ago. Oops. As it has already moved up from 123 to 124.8, but keep an eye on it because I think, like I said, I think that there's potential for a move up all the way up to 126. So I think that there's still upside here. And then finally, the last thing we're going to look at is Bitcoin and Ethereum, which again are also very strongly related or very related to commodities at the moment. I think that they are still inverse dollar plays, and as you can see, the dollar kind of rallying has kind of. I think that there's more going on here than just a dollar rally. Of course, Bitcoin trades on its own fundamentals, but you can see Bitcoin has been stuck in mud. We're reaching a very critical spot here on Bitcoin and Ethereum, and on Bitcoin more than Ethereum. As you can see, Bitcoin had a pretty big drop, and again, it on the chart it's like just looks like a regular correction, but this thing got cut in half in value here, right, from the 60s to the 30s, and it's kind of come down, and it's used this floor around 31 a few times now. And this last break looked like it was a really strong positive development as it started to break out off of a false breakdown, right? So this is usually a really good signal that there's a bottom in. However, it hasn't been able to really get back above its moving averages. And so Bitcoin needs to get right back above the 50-day and stay above the 20 in order to make its way back up into the 40s and try to establish this as a good bottom and then make its way back up. However, if this thing comes down and starts to test the 30s again, there's a good chance that it breaks down, and there's a good chance that there could be another quick vacuum down as it sucks in a lot more traders that are looking to stop out at that level. So I don't think we're totally out of the woods here with Bitcoin yet, but I am seeing more positive momentum out of other cryptocurrencies, which maybe bodes well for the fact that maybe there's going to be Bitcoin, there's going to be more of a rally coming in. And then Ethereum has done a little bit better than Bitcoin. As you can see, it's kind of staved off the bottom. It got above its 20-day pretty clearly, but it's also struggling with its 50. And it's doing the same basic pattern where it had this support floor that it broke down, and then we had that nice rally, but that rally hasn't been enough to really do more than just kind of bounce and get back above the floor. And so we need to see it start to re-challenge some of these higher levels as it gets closer to 3,000 before we can maybe have faith that we've seen a good correction that is at its end, and we're ready to see it start moving forward. And it could also be that both of these are entering what could be another broader range consolidation, but the truth is they've already been doing that for a while, right? If you look at Ethereum, it's been using this as a floor since April, this 2150 area, and even if you go back down a little bit below it to the 1800s, just right where it broke out from its last this triangle here, it's already been using this area as a floor for a while, so it's been trading sideways, even if it did have that explosion upwards. But we've been spending a lot of time at the floor, and I think we've reached the point where we need to start exploring getting back towards the top of that. And like I said, one of the things that bodes well for it is not something that's reflected on the chart yet, because I don't think both charts are showing enough to really get too positive. But as you scroll down and you look at a lot of the other cryptos I follow, you can see that it's almost all green. So there is a lot of momentum returning into the space. These are the areas that got hit a lot harder than Bitcoin and Ethereum did, so they have more room to recover, but we're starting to see a lot of big green candles and a lot of big green moves, which maybe bodes well for the fact that Bitcoin and Ethereum could eventually start to bounce upwards as people start to regain their faith in a cryptocurrency. So this is almost an inverse, or the opposite of what we're seeing in the market, right? Which is the small caps are the ones that are struggling, showing that traders maybe have one foot out the door as they're maybe a little bit nervous about riskier assets. And with the cryptocurrencies, it's the opposite. They are starting to step right back into a lot of the riskier assets, and they're at the moment ignoring the safest two assets, which, as far as cryptocurrencies are concerned, Bitcoin and Ethereum are the two safer ones. And they're the two that are really, at the moment, haven't shown enough momentum to the upside. But we are seeing momentum in a lot of the weaker names. And so we'll see if this is just a temporary blip, or if this is the beginning of momentum coming back into the entire space. All right, so that covers it for today. If anyone has a chart they want me to look at, feel free to type it into the chat. If not, we could pretty much wrap it up as far as what we have for today. Like I said, if you're in here and you don't want to ask in a public venue, you can message me on Twitter, and I'll be more than happy to just send it to you privately. Other than that, hope you guys have a good rest of this week, and we'll meet again next Wednesday.